Hello investors and welcome back. Dividend investing is one of the most popular strategies for generating passive income. Dividends can also help you build long-term wealth. They have been tried, they have been tested, and they have been proven effective. But, like with any investment approach, it is crucial to be aware of possible pitfalls. In today's video, we are discussing the 5 most common mistakes that new dividend investors make. So, if you're just starting to invest in dividend stocks, this is a must-watch. If you're a seasoned dividend investor, you can still use this video to brush up on those essential basics. Mistake number 1. Chasing high-yield dividend stocks. A common mistake new dividend investors make is focusing only on stocks with high dividend yields. 99% of the time, this is a losing strategy. A high dividend yield is attractive, but you must consider other important factors. Stocks very often end up with a high dividend yield after a sell-off. That's why it's so crucial to assess the fundamentals of the company first. What is the company's financial health? What is the dividend history? What about the payout ratio? Are the dividends sustainable? Can the business continue expanding its operations while growing its dividend? Has the company announced any bad news recently? If you ignore these fundamentals, you are putting yourself in a very bad spot. Mistake number 2. Neglecting dividend sustainability. New investors often fail to check the sustainability of dividend payments. Consistent earnings, cash flows, and a healthy balance sheet result in sustainable dividends. If the company doesn't have that, chances are the dividend is unsustainable. A lot of struggling companies take on extra debt to continue paying dividends. I'm sure you can tell, but that's not a winning formula. Like with any rule, there are exceptions, but this scenario often ends up with the company having disappointing returns or cutting its dividend. Mistake number 3. Lack of diversification. One of the most common advices in investing is avoid putting all of your eggs in one basket. Concentrating your investments in a few dividend stocks or within a single industry can be risky. New dividend investors sometimes forget how important it is to diversify. You can spread your investments across different sectors, industries, even geographies. This minimizes the impact of any specific stock or industry downturn on your dividend portfolio. And if you invest for long enough, you will see a downturn. Of course, it also means that you limit your potential profit from that specific stock, but that's a price worth paying if you want to avoid blowing up your portfolio. It can happen to people like you and me, it can happen to professional traders and investors. Nobody is above the stock market. Mistake number 4. Ignoring dividend growth potential. The current dividend yield is important, no question about it, but dividend growth is just as important. New investors often overlook the growth potential of dividend stocks. A company with a small dividend yield but a consistent track record of raising dividends can be a gold mine. Growing dividends also tend to result in a higher stock price over time, so you can be getting the best of both worlds. Picking good dividend growth stocks, reinvesting those dividends, and letting them compound can be a winning strategy. This is also known as the dividend snowball method. This method can take anywhere from 5 to 20 years of continuous investment, but it can really pay off. Mistake number 5. Short-term thinking. Everybody wants to get rich quick. So do I, trust me. But the fact of the matter is that patience pays off. Dividend investing works best when you have a long time span. New investors often get affected by short-term changes in the market. They tend to become impatient when dividends do not provide massive returns quickly. They tend to keep buying and selling hot stocks, chasing that quick price jump. Unless you are the lucky few, this will only lose you money. It is important to have a long-term perspective when investing. You need to take advantage of the power of compounding. The longer your time span, the more likely it is that you are going to profit, and the higher your profit will be. This is also why it is important to set goals, have a plan, and stick to them. So, these are 5 common mistakes that new investors tend to make. I have done them myself, I'm sure you have done some of them yourself. Have I missed any? What mistakes have you made in your investing? Let me know in the comments below. If you enjoyed this video, please leave a like and share it with your friends. Thanks for watching, and I will talk to you again in the next one.